Welcome to my own FP. In this video, we're going to look at Mary and Harry Cherry, who we've previously set up when done their first initial scenario. This video is going to start looking at the grid. So there are a couple options in the main grid. The grid by default rounds to $100, which is adjustable in your preferences. The currency defaults to real. Real dollars are exactly the dollars that you would see in, say, 2040 in your TFSA. If it was $112,000, you would see $112,000. If it's a year dollar, like say 2024 dollars, then that's more of the what you call a constant, the constant currency. So that the same value, if it was in 2024 dollars, that'll be the same value later on in 2024 dollars. So you can explore different currencies. The charts and the grids and all have the ability to flip the currency at any point in time. You can view the grid in either either spouse or joint. There's a lot of different columns in the grid that you can expand and contract. And there's some aggregation features, as well as you can highlight grids, and there's you can actually see the input to the grid. You can do a CSV download of whatever's on the grid. So let's take a look and go and see how all that works in the actual grid. So here we are now. Top left shows what our scenario label is. We have Mary, Harry, and joint. That's our three different views of the grid. So I can flip between Mary, Harry, and joint, and the values change. Since a lot of these things are very similar between them, Mary and Harry are very similar. You can see the employment is 112,000 for Mary, it goes 114. For Harry, it's at 108, 110, goes forward like that. They're working half a year at age 61, so that's reduced in half to the end of June. The main grid might scroll off to the right. So if you scroll a little bit here, the year, age, and all that stays constant, and you can sort of see the left-right scroll and see all the rest of the data on the right-hand side of your screen. There are a couple of features that we have here. The in and out to collapse various columns. So in here, the government one is already expanded. We have CPP OAS. If I want to shrink that, I can just get the total benefits for the government benefits. We'll look at annual a little bit later, just because it really expands out a lot. Investment accounts, you can see this is we have two different non-registered investment accounts. One is called cash, one is called non-registered. So in the cash account, we can see what the growth was in the account, the cash into the account, and the cash out of the account. In all cases, any growth is going to come out of the account because it has to go into gross to be taxed for that year. It may get back in based on what your savings strategies might be. If it's a non-registered account, they're both non-registered, so just in and out and growth. So we sort of see those. If it's a registered account, you'll see a contribution in the growth. In this case, our TFSA contributions and growth. Your RSP account, if the contribution is positive, then it's going in. If it's negative, it's going out. Sometimes it can be, in some years when you're just starting retirement, it could be contributing and withdrawing at the same point in time in certain years as well. So one is a contribution if it's positive, and it's a withdrawal if it's negative. So we can shrink all of our investment accounts to a single column, just if we want. Then it shrinks our whole grid. Our liability accounts, we have our mortgage, and then a summary of that. We can shrink that as well. Our property account, our net worth, and our estate. If we add that, we have what's our taxable income for that year if we happen to pass away in that year, how much tax we would have to pay, and then the residual. Residual is basically, if you look at your net worth minus your residual, that's what it's going to be. Because some of the things go straight into your residual from like your house or your DFSA and things like that. So that's the way the estate works. The little blue 2025, this is where we start computing the values. The purple entries here, purpley pink, are values that we entered into the system. So we entered 108 as our employment. And if we do this in joint, we can see let's just see. We don't enter anything in joint because it's so. But if we entered 112, I entered 45. Now this was split half and half. We entered all the investment values as well. Okay. The slightly other color of pinky purple is things that are computed from the previous value. So we're computing these inflated values here. We're also computing things in your investment accounts as well. They're not in pink because they're not really editable. In a future year, you don't edit what your TFSA balance is going to be in a later year. You could enter, your expense values in later year. So they're slightly different there. If we revert this to 2024 dollars, constant dollars, that we talked about, you can see this is our 50% of our car every 12 years. This is our $90,000 divided by 2, and whatnot. So you can lock your scenario so that you can't change any values in it. You can make it a star, one of your favorite scenarios. You can aggregate various columns. So this is my total OAS that I'm going to receive, my total CPP that I'm receiving, my total OAS that I'm going to receive, total employment, and whatnot. So if we expand this annual one as well, you'll see it's going to cover the whole screen because there's a lot of things in the annual bucket that we end up doing. So if we start off here, we have a pension transfer that Harry has given to Mary. So if we look at Mary's annual, she's receiving that. There's employment values. There's your gross. Earning income is what your RRSP contribution is based off of. So that's your employment plus any net rental income. Deductions are your RRSP, things related to EI, CPP as part of your employment, taxable income so that is your value that is grossed up for dividends and your inclusion rate for capital gains. That is now what our taxable income is. Tax rate, our total tax federal, provincial, payroll tax debits are again part of your CPP. This is our net value after we have our gross income. We strip out our taxes that we have to pay. We end up with our debt. Then we do some after-tax contributions, basically your CPP. Now let's move this to real dollars. After-tax contributions, $7,000 to $500. Our loan payments that we made, 50% of that is $12,000. Our deductible interest, this is just an information column as to how much interest we are paying versus principal. So if you have multiple payments or different things, you can very quickly see what's non-deductible. Your car expense, your normal expenses, and then surplus. So we try to get to a zero surplus for any year by taking income from your RSP or non-registered, TFSA, cash, whatever it happens to be, based on the rules that you've installed the system. There's a set of default rules that do that for you, but you often might want to change what those are. Right now, this is all the default rules. So that's the annual. And then if we look at aggregated gain, we can see that inside annual, we see a lot of, our total earned income, our total deductions, our total tax, total federal tax, provincial tax, the tax rate that we have here would be an average tax rate. As we sort of move across, you can see, total car expenses for this person is $70,000. If we do this in joint, we can also see the aggregate that way as well. So, there are a couple other things on the top. You can add some comments. This is the label, so if you want to change that and save all that. This little icon allows you to see what all the inputs are for the scenario. So we have our basic, this is scenario name. The basic information is, when we started it, start calculation values, the inflation, Mary, just the life expectancy, birth and province, then all our different employment accounts that we have, our home and home mortgage are all put inside there, the defined benefit pension plan, our government benefits, and our rules, which are all the default rules. So you can take a look at what all that means, and you can print that out and save that for future information. So those are the other aspect you can do is you can create a CSV of this data. The CSV will be whatever is currently shown on the grid that you're seeing on the screen. So if you expanded all the annual, you'll see all of that. If I expand all of this, all my investment accounts, all my registered accounts, etc., then all of this will show up in your CSV file. So it'll be for joint, it'll be for real dollars, and all of that data would show up. So if you wanted to do one for Mary, one for Harry, one for real, one for $24, one for aggregated, then you'd have to pick all those different things. So it does one at a time and downloads that as a CSV file. Okay, so that is the main part of the grid. Now we're going to look at a couple columns have a special grid feature. So CPP and OAS and GIS have these. So if we click on the CPP grid, what this shows is how CPP is calculated. So in this case, we said we wanted 90% up until, so we've basically said, our calculations are 100%. Oh, sorry, we just moved the mouse a little incorrectly. CPP. So what we basically have done is we do 100% of our pensionable earnings for 90% of the years, and we end up with our basic CPP. There's a first replacement CPP and a second replacement CPP. There's all these different names, APE and FAPE and SAPE and TAPE, and some of those you can look at in the help. It doesn't explain all how the math works. It just gives you the information in terms of what those acronyms mean. You can take a look and see, and there's some online calculations that explain how that actually works as well. Of course, any grid like this, you can download to CSV as well, based on whatever you're seeing on the information here. And of course, you can aggregate just like you could aggregate in the other grid. We're not going to spend too much time looking at the CPP and OAS. OAS, this is also how it's calculated. There's a bunch of information in here as well that explains, what the income was for the year in 2025, because that income is related to the first 6 months and the second 6 months, because it goes back 2 years and then 1 year to figure out exactly how the OAS is calculated. So you can see how in that grid. The other one that's a little bit more interesting is gross. So now we're going to look at the gross income grid. So this is all the information that you have for what is into gross. So this is the main column over here that you're going to see in the main chart. And what we do is we say for each of the income streams that comes in where it came from and what type of income it is, for example. So if we look at CPP, this is why did this come into gross? It's just a transfer that's taxable. So same with OAS, same with employment. Those are just your normal things. That's a taxable thing. Income for cash, this is a taxable growth thing that has come in. If we look at return of capital, this is just, we do put it into gross. It's taxed at 0%. It's just, there's an exclusion rate for it. So return of capital goes into gross, so we know that is money that we actually have available to us. But it is not taxed in any way, sort of thing. So it's not taxable. And you can see this came from, in this particular year, we took $7,500 out due to a desired saving rule number 2, which is our TFSA. So we took our TFSA out of cash and put it into our TFSA. And we also, in this case here, let's just do the tooltip, had an additional income rule of $9,000. So in this year, we were buying our car, so we needed additional money, so we took some money from cash to purchase that car. Again, non-registered account, which is like your stock portfolio. There's growth. There's dividends. A little bit more interesting is a little bit here. You do get some cash growth. You also get, in this case, we've run out of cash in our cash account, so we're taking stuff from our non-registered account, putting that into our desired saving rule number 2, which is our TFSA. So between that $4,200, and if I look at the return of capital, it also has that. So we sold some portion of our non-registered account and put that money into our TFSA. So that's where that contribution rule is there. A little bit of this taxable growth is because we have a 0.3% capital gain every year within this account. And we also have some dividends every year. So that's what that comes into. Your RRSP, we split our RRSP into income and pension income. Income is before 65. Pension income is after 65. If it was a defined benefit pension plan here, you would have pension income all the way along, even before 65. So if we look at additional income rule 3, which is this additional income rule says pull money from my RRSP or RIF. So we took $53,000 out of our RIF that year. In particular, we already had a lot of employment income. In this case, due to the rule, however it is, we have to purchase our car. So we took some out of our RIF. We also took some out of cash. At 62, we have a RIF minimum, and then we took some out in addition to our RIF minimum as well. So it's a reasonably aggressive strategy. We're taking a lot out in our 60s because we retired at 61 and a half up until we're 65. We can see the additional income rule is much more than our minimum. Eventually, once we're 65 and we're getting some CPP and OAS, our additional income that we're taking outside of our minimum is going to be a little bit less. And then when CPP and OAS really kick in, then the next year at 66, we take even a little bit less. The reason at 65 is you apply for it on your birthday. By default, it comes the month after your birthday. So it's a lot less in the year of that you start applying for it. So that's the way that works. So we have a bit of an aggressive RSP meltdown for a bit, and then it's relatively slower at that as we sort of move along throughout the years. But it definitely, we'll look at later. There's going to be another video when we want to take CPP at 70, and then there's going to be another video where we're really going to try to hammer the RSP down and melt it down by the time we're 80 or 85, somewhere in that sort of neighborhood as well. He gets his pension income from this is a transfer from Harry. So Mary got this additional income from Harry. If we look at Harry, he got his defined benefit pension plan. He's getting $5,000 Every year it's non-indexed. And then you can see when we transfer it to gross, we're taking some portion of that back out, and Mary is going to get access to that. Okay. So this is a relatively useful grid to take a look at and go, in what years, how much money should I take from my RSP? How much is the minimum? How much money do I need outside of that? How much am I getting from my non-registered accounts? How much am I paying tax on those? Should I take money from each of those things? Your rules determine exactly where it's all coming from in those years. And it's important to understand how those rules interact with the system. Okay. So that is the main aspect of our grid. We can take a little bit look now at, is this a good scenario or not? Now that we did some navigation. One more navigation small point was these shortfalls of $0. Because we're rounding to the nearest 100, these are going to be shortfalls of $1 that round to 0. The system just, once we get to below $2, we don't bother in taking one more dollar out of something, just another run through the system. It is what it is. You can pretty much ignore it. It has to be accounted for, but it's obviously not significant. The reason, we also round to 100 is, when you have $850 and $900, then, if that was $12 in addition to that, it's not really significant and makes it hard to understand what the grid is doing, whether you have just too many numbers in place. But that's up to you. It's available in your preferences. You can see what you want to be able to do with, you can go all the way to $1 if you want on the main grid. If you notice, the gross grid does it all to $1, and the CPV and the OS grids also do it to the dollar as well. So it's just the main grid, just because the numbers are often a lot higher. The RSP meltdown, you can see here we started contributing to our RSP more and more. Contribute, then we are taking a lot of money out, $50,000 out of our RSP, then a little bit, and then we start dropping to $20,000. When we buy a new car, we're taking more out of our RSP. You can tell the car expense. If you wanted to not take it out of your RSP, you could say take it out of cash, or take it out of non-registered, take it out of your TFSA, take it out of a line of credit. In this default plan that we set up, we didn't bother doing that, so you'll see that as little spikes every 12 years. You can, obviously, as I say, you can adjust that to what you want. So our RSP, at the end of the day, the main RSP account, get rid of the growth. By the time we're 90, it's $101,000. At 85, it's $200,000. Relative to our overall net worth, it's not a significant value. Most of our money at this point in time is tied up in our house or in our TFSA, which is a good place to have. Most of your money now tied up because it's tax-free. You can do whatever you want. It's kind of beneficial to have a little bit still in your RSP. Maybe you don't want to plan it that way, but this allows you to average out your tax bill a little bit longer, but maybe you want to drain that RSP at 80. Some people really want to drive it down. You can look in, as we'll show in various scenarios, why that's good, why it's a little bit, sometimes it can be bad. It's not necessarily, it's up to you as an individual what you want to drive your RSP down to by what year. The default does it like this. For this particular scenario, there's other scenarios where even the defaults would drive it down faster or slower. It all depends on, and then you can adjust all that. So this is the main grid. Thanks for watching, and our next video we'll start looking at charts and see how they show the same data that we see in the grid in a more visual format. So thanks very much for watching.